The White House just announced something that could completely change homeownership in America, the 50-year mortgage, and the internet is wildly divided on this. Some say that it's the key to affordable housing, and others say you'll literally die before you pay off the biggest asset that most Americans will ever own, their homes. So which is it? Today we're going to break down everything that you need to know about the 50-year mortgage, and trust me, the numbers might shock you. So let's jump in. So what exactly is the White House proposing? This past weekend, the Federal Housing Finance Agency Director Bill Pulte confirmed they're actively working on the 50-year mortgage option. He's calling it a complete game changer for housing affordability. The pitch is pretty simple. Stretch your mortgage payments out over 50 years instead of 30, and your monthly payment significantly drops. So let me give you a real example and show you what the monthly payment difference looks like. On a $400,000 home with a 20% down payment at 6.575% interest, a payment on a 30-year mortgage is $2,038 per month, and a 50-year mortgage would be $1,822 per month. That's savings of about $216 or roughly $2,600 a year. Sounds pretty good, right? Well, hold that thought because we're going to talk about the full picture. But first, let me give you some historical context that'll help you understand why this matters so much. Before the Great Depression, buying a home was completely different. In the early 1900s, if you wanted to buy a home, you typically needed to put 50% down. That's half of the purchase price, and you could only get a 5-year loan term. But here's the kicker. These weren't like modern mortgages. You only paid interest for those 5 years, and then at the end, you either had to come up with a massive balloon payment for the entire principal or refinance, and it was basically impossible for average Americans to ever fully own their home. And then the Great Depression hit. Hard. Housing values dropped about 35%, and a house that was worth $6,000 in 1929 was suddenly only worth $3,900 by 1932. And by 1933, we were seeing over 1,000 foreclosures every single day. That's when President FDR, his New Deal, created the Homeowner Loan Corporation in 1933. And this organization started refinancing those risky balloon mortgages into longer-term, fully amortized loans with 20 or 25-year terms. And then in 1934, FHA was created, which laid the groundwork for even longer-term mortgages. But 30-year fixed mortgages didn't become widespread until the 1950s and really took hold in the 1960s. And that's when it became the American standard that we all know today. So let's talk numbers between 1960s versus today. Back in 1963, when the modern 30-year mortgage era really began, the median home price was $19,300 and the average income was around $6,200 per year. That means a home cost about 3.1 times the annual income. Fast forward to 2025, today, the median U.S. home price is around $410,800 and the median household income is around $83,400. That means a home costs 4.9% of your annual income. But let that sink in for a minute. That's a 58% increase in how many years of income it takes to buy a new home. Put it this way, when your parents and grandparents were buying homes in the 1960s with these new 30-year mortgages, a house cost about 3 years of income, and today it costs nearly 5 times that. But the 30-year mortgage was revolutionary in the 1960s. It made the American dream accessible to the middle class. Post-war prosperity meant that wages were rising, families were growing, and people could actually afford these payments. The home ownership rate skyrocketed between 1940 and 1960. So here's the big question. In an era where homes cost 58% more relative to the income that they did in the 1960s, when the 30-year mortgage became standard, will stretching it into 50 years solve the problem or just mask it? That's what we need to figure out. So let's create a list of pros and cons. On the pro side, all right, let's be fair to the potential benefits. There are some arguments in favor of this. The first one is lower monthly payments, and this one's pretty obvious. Let me show you a bigger example. For a $500,000 home with 20% down at 6.575, the 30-year mortgage is $2,548, and the 50-year mortgage would be $2,277 per month. That's a savings of $270 per month, or over $3,200 per year. For first-time homebuyers who are stretched thin and trying to qualify for a loan, that monthly payment could literally be the difference between getting approved and not. Benefit number 2, qualification flexibility. Now here's a sobering stat. The average age of first-time homebuyers has hit an all-time high of 40 years old in 2025. The typical first-time homebuyer is now as close to collecting Social Security as they are to graduating high school. For a 50-year mortgage, that would theoretically help younger buyers get into homes earlier in life when they're in their late 20s and early 30s instead of waiting until they're in their 40s. Benefit number 3, cash flow management. If you're self-employed, work on commission or big quarterly or yearly bonuses, or you're investing heavily in a business, the lower required payment gives you more financial flexibility month to month. You're not having to be locked into that higher payment when you might have a regular income. Benefit number 4, the you can always make an extra payment argument. This one is something that I think we'll hear a lot. Just because it's a 50-year mortgage doesn't mean you have to take 50 years to pay it off. The argument goes like this. Take the 50-year option for the flexibility, but you can make extra principal payments whenever you can. Pay it off in 30 years or 20 or even 15 if you're able to, but you get the lower required payment as a safety net and you're not forced to keep it that long. On paper, that sounds reasonable. In practice, well, we'll get to that. Those are the arguments in favor of a 50-year mortgage, and I'll be honest, they're not completely without merit. Now we're going to get real about the downsides because they're pretty significant. Problem number 1, the interest cost is absolutely staggering. Let me break this down into a classic real-world example that'll make your jaw drop. Let's say you're taking out a $425,000 loan at 6.5% interest. With a 30-year mortgage, you'll pay $542,064 in total interest over the life of the loan. With a 50-year mortgage, you'd pay over $1 million in total interest. That's an extra $470,414 in interest payments alone, nearly $500,000 more just to save $290 a month. Think about what you could do with that extra $470,000. That's retirement money. That's college funds for your kids. That's generational wealth that you can pass down. And you're giving it to the banks just to lower your monthly payment to the cost of a few $100s each month. Problem number 2, equity builds at glacial speeds. With a 50-year mortgage, very little principal is getting paid down in those early years. Some experts have said it would practically function like an interest-only loan because realistically, very few people are going to keep a home for 50 years. Here in Charlotte, and frankly across the rest of the country, the average person moves every 7 to 13 years. And if you sell your house in 10 years with a 50-year mortgage, you'll barely have any equity built up compared to what you would have with a 30-year mortgage. That means when you go to sell, most of your payment has gone to interest, not actually building personal wealth. Problem number 3, higher interest rates. Here's something that doesn't get talked about enough. We're using the same interest rates for 30-year and 50-year, but a 50-year mortgage would almost certainly come with a higher interest rate than the 30-year mortgage. Why? Because lenders view the longer time frame as carrying more risk of default over time. Think about it. We've already seen this pattern with existing mortgages. A 15-year mortgage has a lower rate than a 30-year mortgage because there's less risk to the lender over that shorter time frame. So a 50-year mortgage would likely have an even higher interest rate than a 30-year. That means all those payment comparisons that we just talked about, well, they're probably optimistic. Your actual monthly savings are probably less than are being projected. Problem number 4, you literally might die before paying it off. Now, I know this sounds dramatic, but I'm not exaggerating here. Representative Marjorie Taylor Greene plainly stated when criticizing this proposal, people could pay far more in interest over time and die before they ever pay off their home. Now, let's do the math. If you're 40 years old when you buy, which is the current average age of a first-time buyer, you'll be 90 when the mortgage is paid off. Even with life expectancies continuing to grow, are you planning to work until you're 90? What happens to your retirement plans when you still have a mortgage payment in your 70s and 80s? Think about that. Problem number 5, it could actually make housing less affordable. This one is the counterintuitive point that really matters. Housing analysts have pointed out that subsidizing demand without increasing supply could actually cause home prices to increase, which would completely negate the potential savings of a lower monthly payment. Think about it this way. If everyone could suddenly afford higher priced homes because of the 50-year mortgage option, what do you think sellers are going to do? They're going to raise their prices because it's basic supply and demand. So you might end up in the situation with a home that costs $400,000 today suddenly costs $450,000 or $500,000 because those buyers have more buying power. And suddenly you're right back where you started, except now you're locked into a 50-year payment schedule. Problem number 6, legal and regulatory hurdles. Here's a practical problem. A 50-year mortgage doesn't currently meet the definition of a qualified mortgage under the Dodd-Frank Act, a law that was passed in 2008 after the housing crisis to protect consumers. Changing this would take up to a year and would require congressional approval. So even if you wanted one of these loans, it's not happening tomorrow. And these are serious concerns. They're not just theoretical. They're based on real financial analysis and historical patterns. Now, some of you watching this might be thinking, wait a minute, this sounds familiar. Haven't we seen something like this before? And you'd sort of be right. Let's compare the 50-year mortgage to an interest-only mortgage because they share some of the same DNA, and that's actually kind of concerning. So what's an interest-only mortgage? Well, an interest-only mortgage is that you typically only pay interest on the mortgage and not actual equity. During that time that you own the mortgage, no equity is being built in the property except for its appreciation. So here's a real example. Let's say you take out a $350,000 loan at 6.5% interest on an interest only. Your payment would be $1,895.83. And that same amount of money on a 6.5% 50-year mortgage would be $1,973. That's only a savings of about $73, which means that's how much goes to principal in your first year. Now, both result in very slow equity build over time. Both involve paying significantly more interest overall compared to a traditional 30-year mortgage, and both can result in what I call financial reality shock later on when you go to sell. And here's the thing that should concern everyone. Interest-only mortgages were a major contributor to the 2008 housing crisis. They ended up causing thousands and thousands of homeowners to default as foreclosures exploded and property values dropped. We literally passed laws in 2008 to prevent this kind of thing from happening again, and I don't personally know a lot of people that have taken an interest-only mortgage since 2008. The bottom line is that both of these products, interest-only and 50-year mortgages, allow you to buy more house than you technically can afford with a traditional 30-year mortgage, and that's exactly why they're both risky. If you need exotic financing to afford a house, the market's telling you something important. All right, let me bring this home, literally, to our Charlotte market, because that's where the rubber meets the road for most of us in the metro area and most of the people on this video. Right now, the median home price in Charlotte is sitting around $400,000. So let's use that to see what a 50-year mortgage would actually mean for someone that's buying here. On a $385,000 purchase price with 20% down, you'd be financing around $308,000. With our current 30-year mortgage rates, you're looking at about $1,900 to $2,000 a month. And with 50-year mortgages, that might drop to around $1,700 or $1,800. So you'd be saving roughly $200 to $250 a month. But over the life of the loan, you would pay an extra $400,000 to $500,000 in interest, and your equity would be minimal for the first 15 to 20 years. That's what makes this particularly relevant to our market. Number one, we're still seeing strong population growth here in Charlotte. Companies are relocating here, people are moving from higher cost areas, and our job market is really solid. Number two, home prices in Charlotte have appreciated significantly over the last decade. We've seen tremendous growth. And number three, the key question here is, do you want to bet on Charlotte appreciation continuing strong for the next 50 years? My take on Charlotte. With Charlotte's strong job market, continued population growth, and economic diversity, building equity matters more here, not less. This is an appreciating market where you want to own as much of your home as possible so you can capture that growth. A 50-year mortgage means that you're essentially renting from the bank for decades before home values potentially increase around you, but you're not capturing as much of that appreciation because you literally own less of your property. If you're looking in popular Charlotte neighborhoods, Myers Park, Dilworth, Plaza Midwood, South End, Ballantyne, or growing areas like Belmont and Cornelius, you want to be building equity, not treading water for a decade. Okay, so in the interest of being completely fair and balanced, let me tell you the specific scenarios where I believe a 50-year mortgage might make, and I emphasize might, make sense. If you're someone who makes scenario number one, high income earners with irregular income, if you're someone who makes $400,000 a year, but your income comes in chunks, maybe you're a real estate investor, you work on large commissions, or you have huge seasonal bonuses, or you're a business owner that takes a 13th month, you might want that lower required payment as a baseline. But the key is you'd have to be disciplined enough to make these large lump sum principal payments when you have the cash. This is not for the average person. Scenario number 2, real estate investors. If you're buying rental properties and you're prioritizing cash flow over building equity, a 50-year mortgage might allow you to carry a few more properties that cash flow positively. But even then, I'd argue there are better strategies for building a rental portfolio. Scenario number 3, extremely sophisticated financial investors. If you have a significant investment portfolio and you genuinely believe that you can earn returns that exceed your mortgage interest rate consistently over multiple decades, then maybe the math works out, where you invest the payment difference instead of paying down the principal. But let's be honest, this is less than 1% of home buyers, and even for them, it would be debatable. Scenario number 4, short-term ownership plans. If you're planning to refinance within 5 to 10 years, when you expect your income to increase significantly, you might use the 50 years as a temporary bridge. But here's the problem. Life rarely goes according to plan. What if you can't refinance? What if rates go up? What if your income doesn't increase as expected? So here's the reality check. Even in these scenarios, you'd need incredible financial discipline. And there's regulatory hurdles too. Right now, a 50-year mortgage doesn't even meet the qualifications for a mortgage definition under Dodd-Frank Act. And changing that could take a year or more with congressional approval. So even if you fit into one of these narrow categories today, it's not likely that you're going to be able to go out and get one of these loans anytime soon. So after all this, all the pros, all the cons, all the comparisons, let me give you the bottom line take as somebody who's been in the Charlotte real estate and helped thousands of families buy and sell homes. Housing needs to balance itself through slowing home prices and wage increases the way it has for decades. And adding another subsidy to the market just prevents that healing process from happening. The real issue is that mortgages aren't too short. The issue is we have supply and demands that are out of balance, construction costs that keep rising, zoning laws and regulations which make it harder to build, especially in metro areas, and wage growth hasn't kept pace with home prices. A 50-year mortgage is treating a symptom, not a disease. It's putting a Band-Aid on a broken bone. If you can't afford the payment on a 30-year mortgage, you probably can't afford the house. Period. I know that's hard to hear, especially for first-time homebuyers who are frustrated by this market. But taking on a 50-year mortgage means sacrificing hundreds of thousands of dollars in wealth building just to squeeze into a house today. Focus on building equity, not just getting in the door. Think about long-term wealth building, not short-term payment relief. If you're considering a move to Charlotte or you're already here and looking to buy, here's what I'd recommend instead. First, focus on getting the best possible rate on a 30-year mortgage. Shop around, talk to lenders, get your credit score as high as you possibly can. Second, if you're able, make a larger down payment. Even an extra 5% down can make a big difference in your monthly payment and how much equity you build. Third, consider up-and-coming neighborhoods where values are still relatively reasonable. Charlotte has amazing growth potentials in areas that haven't really peaked yet. Places like Belmont, Concord, Kannapolis, and parts of North Charlotte, as well as Rock Hill, offer great value. Fourth, remember that building equity is building wealth for your future. Don't sacrifice that for a lower payment today. All right, now I want to hear from you. What do you think about the 50-year mortgage? Would you ever consider one? What would make it worth it to you? Drop a comment below. I read every single one of these and I'm curious to hear your perspective. And if you're thinking about buying or selling in the Charlotte area and you want to talk through your options with someone who's going to give you straight answers with no BS, just real advice, reach out to us. Send us an email, info@jwhitegroup.com, and don't forget to subscribe to Realize Charlotte for more real talk about the real estate market in Charlotte. We're going to give you information to make smart decisions, and that's probably the biggest financial move of your life. Thanks for watching, and we'll see you next time.